Kia ora, and welcome to the Cotality Property Market Update for Piperi, June 2026. Brought to you by Loan Market. The Aotearoa property market is effectively treading water as economic uncertainty weighs on buyer sentiment and slows activity. The May Home Value Index saw the nationwide figure unchanged, holding the median value at $808,000. Values remain 0.6% below the same time last year. Reviewing the 3 months since the war in Iran began, once again shows a few clear regional differences. Weakness remains evident in both Te Whanganui-a-Tara, Wellington, and Tamaki Makaurau, Auckland, with values down 0.6% and 0.5% respectively over the last quarter. Minor change over the same period for Tauranga, down 0.1%, and Kirikiriroa Hamilton up 0.2% indicates more balanced markets, while the main centres down south have experienced more solid gains. In Ōtautahi Christchurch, values are up 1.4% over the last quarter and 3.2% over the last year. Meanwhile, Ōtepoti Dunedin values have increased by 0.8% and 2.7% respectively. It's a segment of the market we never tire of talking about, and first-home buyers continue to more than hold their own. With 2/3 of the second quarter complete, they've picked up a record share of purchases, 28.5%. Time will tell whether they can keep up this activity, but the factors contributing to it are well worn. Access to KiwiSaver balances for deposits, making use of allowances outside LVR lending restrictions, exiting an expensive rental market, improved mortgage affordability, a long-term horizon outlook, and holding the balance of power against plentiful supply have all held true for a while and don't appear to be likely to change anytime soon. Meanwhile, there are stronger signs that mortgaged multiple property owners are taking a more cautious approach in these uncertain economic and volatile geopolitical times. Their share of purchases has dipped to 22.4% so far in the second quarter, down from 23.5% in Q1 and 24.3% in Q4 last year, after previously gathering a bit of momentum. Net migration has continued to improve, with the annual flow up to almost 23,000 at the end of April, as fewer Kiwi leave the country and more migrants arrive. While that's a decent lift on the trough of 10,400 arrived at in August last year, it remains below the average of roughly 30,000. So although this should provide more rental demand in the short term, it's unlikely to result in recently constrained rents appreciating to any great degree, especially with rental property supply remaining high. For owner-occupiers considering their next move, downgraded economic growth prospects and delayed improvements to the employment market is also likely to push their expected recovery back further. 25.9% of sales have gone to this group so far in the quarter, a continuation of their cautious level of activity in uncertain times. That's not to mention the nature of increasing mortgage interest rates, which are already seeing a growing number of borrowers refixing to higher rates. For example, a borrower who fixed for 6 months in October last year at 4.8% would be shifting to a rate of around 5.1% if they moved to the currently popular 2-year term. This is notable because it illustrates that the run of loosening monetary policy to boost consumer spending is likely over, extinguishing one of the final threads of short-term hope for the wider economy. The Reserve Bank's monetary policy statement and associated official cash rate review at the end of May did little to quell fears of the tightening cycle being imminent, despite the decision to hold the OCR at 2.25%. Crucially, the decision from the committee was only confirmed by the governor's casting vote, after the committee was completely split 3-3. The internal bank committee members appeared more confident that second round inflation would remain contained, while the external members believed the opposite. So, the lingering debate remains. How stubborn will medium-term inflation be? And how will the economy handle a higher OCR, given the impact of high oil prices and supply chain disruptions? Following that split vote commentary, it appears we're about to find out, as the bank's forward guidance clearly pointed toward an increase to the OCR in July. For current homeowners wary of price falls, relatively favourable affordability figures show most measures are back to long-term averages, which should keep a structural floor under values and pave the way for growth to eventually re-emerge, probably once there's genuine resolution in Iran. But the timeframe on that remains incredibly volatile, despite recent news yet again of apparent ceasefire. Finally, a word on the speculation of New Zealand becoming a tax haven for Australian property investors, following proposed tax changes across the Tasman. This sits firmly in the headline-grabbing category. The truth is, those investors would likely still carry a tax burden back home. We aren't exactly forecasting a strong capital growth track here anyway, and we have our own upcoming political cycle to consider as we inch closer to the November 7 general election. Stay up to date with all the latest movements at cotality.com/NZ. Follow Cotality NZ on social and subscribe to New Zealand Property Market Podcast on your preferred platform. Mā te wā.